All right, the indirect method, this is going to start with net income, and you basically back out everything. So you back out uh, different non-cash flowing items. As I said before, the investing and the financing, these items are going to be the same regardless of what method. The only difference for the methods is the operating section. So we are going to adjust net income for accruals and non-cash charges to get cash flows. Really, all this is going from accrual-based net income to cash basis. It's super slightly different, but that's the absolute best way to describe it. Because I'll run through a little bit right here for you. Why not? Let's talk it through. So if we've got $100,000 of net income, well, that, let's say, accounted for 20,000 of depreciation expense. Well, depreciation expense isn't real, right? It's not real. There's no cash changing hands there. So what are we going to do? We're going to add back $20,000 of depreciation expense because that was not really money out the door, but our accrual basis net income accounted for it. So that would get us to $120,000. Now, let's say, what else? That is a non-cash. Another non-cash could be a gain or loss on the sale of an equipment. Another common one you'll see. Now, if we have a gain, that gain was not real, correct? That gain, no cash actually changed hands because of that gain. It's just keeping track of gains and losses on the sale of equipment. Let's say that gain was $30,000. Well, that $30,000 was included in this. So that was not real money in the door. So we would subtract out $30,000, bringing us then to $90,000. You can keep going over and over with that, right? You could definitely keep doing that, as well as different accrual-based methods. We're trying to back it out. Let's say we accounted for a loss, you would just reverse and add it back in. That's the indirect method. Whereas the direct method, I'll go over here again. Let you look at your T account. If cash in the door was debited for $100,000, awesome. That's going to be included. If cash was credited separately for $20,000, you would subtract that out. It's much more simple. You just look at what actually happened. The cash in versus the cash out. All right. Now, more on the indirect method. We make adjustments to net income. We always start with net income. Whenever you're seeing an indirect method question, just have your eyes jump to net income. That is where we'll start. We begin with that rather than the cash inflows and outflows, like with the direct method. The indirect method essentially backs it out. That's the best way to describe the process, right? It backs it out. This includes considering all deferrals of prior operating cash receipts and disbursements, such as subtracting increases in inventory and prepaid expenses, all accruals of expected future operating cash receipts and disbursements, such as subtracting increases in accounts receivable and adding increases in accounts payable and accrued expenses. So again, this is the same process as if we were going from accrual to cash basis. All non-cash flowing items that are included in net income, such as gains, losses, depreciation, etc. So under the indirect method, also, net income is adjusted to arrive at net cash flows from operating. In addition to that, supplemental disclosure of cash paid for interest and income taxes is required. We need to just disclose those and talk about them. It's important, right?